Welcome to the ProTicker Deep Dive. For the last couple of years, if you've listened to any financial coverage of AI, the focus was overwhelmingly on the software layer. We were all just fixated on the competition between large language models, the speed of new chips, and, the cost of the silicon.
And that competition is absolutely real, but that fixation,
Hmm.
it sort of obscures the most fundamental constraint governing this entire AI build-out.
The real bottleneck.
Exactly. Before any model can generate a response, before any GPU can even run a calculation, it needs a continuous, massive supply of power. The core idea that Wall Street is only now, I think, beginning to fully model is that electricity and power infrastructure is the true non-negotiable bottleneck for the entire AI economy.
Okay, so let's unpack this. I think we need to quantify the sheer scale of the demand you're talking about because some of these consumption stats are they're truly staggering.
Yeah.
Let's start with something we use every day, inference.
Right. So a single search run using a generative AI, something like ChatGPT, it uses about 10 times the electricity of a traditional non-AI Google search.
10 times. That difference, that tenfold jump, it really highlights the inherent inefficiency of this new kind of compute.
It does, and that's just for a quick interaction. If you look at training the foundational models, the numbers absolutely explode.
How bad is it?
Our sources highlight that training a model like GPT-3 consumed roughly 1.3 gigawatt hours.
Wow. 1.3 gigawatt hours. Put that in perspective for us.
Okay, so think about it this way. That 1.3 gigawatt hours is the equivalent power usage of about, let's say 120 to 130 average American homes over an entire year.
For one training run.
For a single dedicated training run, yeah.
So what does this level of demand actually mean for the public utility grid, which, was built decades ago?
It forces a structural shift. You're talking about how a fundamental commodity electricity is allocated in the U.S.
And data centers already use a significant chunk.
They do. They currently consume about 4% of total U.S. electricity, which is already a big number.
But the projections are where it gets really urgent.
That's where the story is. Analysts suggest that data center consumption could jump to 9% of the U.S. total by 2030. And some projections are far more acute, estimating maybe 12% by 2028.
So you're talking about potentially tripling the percentage of U.S. electricity dedicated just to data centers in, 5 years?
In 5 years. This isn't just gradual growth. This kind of structural reallocation of a fundamental resource is, it's unprecedented.
And that structural change is precisely why we're doing this deep dive. Our mission today is to unpack the source material and really show you why utilities, which, have historically been the definition of boring, low-growth dividend plays,
The safest, most boring stocks you could own,
are being fundamentally repriced as high-growth AI infrastructure companies. This demand surge is creating multi-year, multi-decade opportunities across the entire energy supply chain. This resource war, it really started quietly but aggressively the moment ChatGPT was released in late 2022.
That's the inflection point. The entire tech sector realized they were in a compute race, and the capital expenditure required to win is just. It's resetting global spending records.
And the response from the hyperscalers has been almost existential.
It has to be. They're buying the chips, sure, but they also have to pay for the facility and, crucially, the power to run them. Alphabet, for instance, dramatically increased its 2025 CapEx target to $85 billion. That's up $10 billion from their earlier estimates.
And that money is going directly toward building out cloud and AI infrastructure.
Directly. And Meta spending is, if you can believe it, even more aggressive. It really signals just how pivotal this infrastructure race is.
What are their numbers looking like?
Meta is deploying between $66 billion and $72 billion in 2025 CapEx. That's a massive year-over-year jump of roughly $30 billion.
$30 billion.
And that unprecedented capital is dedicated almost entirely to AI data centers. To really get the investment thesis here, you have to understand the scale of the power they are demanding.
So we've established the consumption per calculation is high. But when you aggregate the entire industry, what's the required power scale we're actually talking about?
The scale is transformative. AI-specific servers consume somewhere between 53 and 76 terawatt hours of electricity in 2024 alone.
And that's just the start.
Just the start. More broadly, data center power demand is projected to grow 160% globally by 2030 compared to 2023 levels. The visualization is key here. A single, modern, large-scale data center can now approach 1 gigawatt of continuous power draw.
1 gigawatt. That's just a staggering number.
To put that into perspective, 1 gigawatt is equivalent to the peak hourly demand of entire, smaller European nations.
So in the U.S. alone.
In the U.S. alone, data centers are expected to add 60 gigawatts of demand by 2030.
60 gigawatts.
Which is roughly equivalent to the peak hourly electricity demand of a G7 nation like Italy. We are essentially building the equivalent of Italy's entire power grid just to run AI compute in the next 6 years.
The problem then is obvious.
Yeah.
The existing supply chain, the grid, it was designed for stability and gradual growth spread over decades.
Exactly. It was not built for exponential, hyper-concentrated demand, where one single facility suddenly pulls 1 gigawatt.
So why is the supply side failing so acutely to keep up?
Because grid upgrades happen at the speed of steel and bureaucracy, not at the speed of software.
Right.
Transmission system upgrades. So the physical lines moving electricity from the plant to the data center, that can take 5 to 10 years just for permitting, siting, and construction.
And we're seeing the immediate pain points right now in these critical regions where data centers have clustered.
Yes, the system is visibly stressed. Northern Virginia's famous data center alley is getting close to its practical capacity limits. And crucially, the PJM interconnection, which is the massive grid operator covering the Mid-Atlantic and Midwest, is experiencing acute pressure on its capacity markets.
That's a key technical concept. Let's clarify that for our listener. When we talk about the PJM capacity market, what exactly is that, and why are data centers pushing the costs up so high?
Okay, so the capacity market is essentially an auction. Power suppliers bid to ensure they can provide sufficient electricity on the hottest, highest demand hour of the year, years in advance. It's a mechanism to ensure long-term grid reliability.
And data centers are messing with that
And
mechanism.
overwhelming it. Because their demand is so massive, so predictable, and so inflexible, they're forcing suppliers to build expensive, dedicated new generation just to satisfy them. This has accounted for over 60% of capacity market price increases in recent PJM auctions.
What's the dollar figure on that?
It totals $9.3 billion.
So the immediate implication for the average person listening is that the cost of these grid infrastructure upgrades, the ones needed for AI, is already being socialized.
Precisely. That $9.3 billion in market price increases is ultimately absorbed by the system, which means ratepayers, the average electricity customer, are footing the bill. You are, through your monthly bill, effectively helping to pay for the infrastructure that powers the next generation of generative AI.
Which brings us directly to the solution the major tech companies have realized is necessary. They're effectively opting out of the problem.
They are. They're going straight to the source. Nuclear power. It perfectly solves the baseload capacity and the sustainability dilemma.
Because it's constant.
It's the immediate answer. Nuclear provides constant, non-intermittent, carbon-free power that can run 24/7. It offers stable energy prices, insulating the tech giants from the price volatility of natural gas.
And it ticks the sustainability box.
Critically, yes. It satisfies their sustainability mandates. They aren't waiting for the traditional slow-moving utility planning cycle anymore. They are securing dedicated supply directly.
And we are seeing concrete examples of this pivot through these massive bilateral contracts.
We are. These are large-scale, long-term power purchase agreements, or PPAs.
Break that down for us. What is a PPA?
For those unfamiliar, a PPA is simply a contract between a producer and a consumer to buy a set amount of power at an agreed-upon price over a defined, often multi-decade period.
And who are the big players making these deals?
Well, Amazon Web Services, AWS, struck a massive deal for about 960 megawatts directly from a nuclear plant in Pennsylvania. Then you have Google, which has gone a step further.
What do they do?
They signed a master plant development agreement with Kairos Power to deploy advanced small modular reactors, SMRs.
Okay.
They're modular nuclear facilities that can provide up to 500 megawatts. And SMRs are a potential game changer because they can be sited much closer to the data center itself.
And there was a major deal out of Texas, too, with Vistracor.
Correct. Vistra announced a 20-year contract to sell 1,200 megawatts from its Comanche Peak nuclear plant in Texas to an unnamed major customer.
Which is almost certainly a hyperscaler.
Given the magnitude and the duration, absolutely. These contracts are for billions of dollars and decades of guaranteed supply. They fundamentally alter the economics of the entire power sector.
So this creates a fascinating new energy model. Companies like Google, Microsoft, Amazon's AWS, they're effectively creating their own private infrastructure.
That's a great way to put it. By investing directly in generation and signing these bilateral PPAs, they're insulating themselves from the congestion and the cost of the public grid.
And what's fascinating here is the broader societal implication.
It is. The deep pockets of these tech giants are accelerating capital deployment into nuclear and non-intermittent renewables way faster than traditional regulatory or utility planning would ever allow. The tech sector is essentially subsidizing the transition to cleaner 247 power generation,
Why?
simply because they have an inelastic, urgent need for electrons.
This demand reset leads us directly to the fundamental investment thesis shift. Utilities were, as we said, the ultimate boring dividend plays safe, slow-growth income streams. Now they are being repriced.
Repriced as high-growth, essential AI infrastructure plays. That traditional narrative is just collapsing completely. Look at the price signals. The average U.S. retail price of power rose 6.5% between May 2024 and May 2025.
But in the data center hotspots,
It's way higher. Wholesale capacity costs have risen as much as 267% over 5 years. Grid operators are just running out of cheap, dispatchable supply, and every new gigawatt of data center demand pushes that price curve dramatically higher.
and we can see the direct market impact of these deals by looking specifically at Constellation Energy. It's quickly becoming the poster child for this AI power supercycle.
It really is. Constellation, one of the largest pure-play nuclear generators in the U.S., now trades at a forward price-to-earnings ratio of around 37x.
37 times for a utility.
For an investor, that should be shocking. A valuation of 37x PE was traditionally reserved exclusively for fast-growing tech companies, not a capital-intensive utility that operates nuclear plants.
So what caused that extreme valuation jump?
It's the visibility provided by AI demand. This high valuation is directly attributable to that multi-gigawatt PPA they signed with Microsoft.
And what does that one deal do for their earnings?
That single deal is expected to increase Constellation's annual base earnings per share growth rate from a respectable 10% up to an astonishing 13% through 2030. That is repricing based purely on guaranteed long-term AI-driven revenue.
And Constellation isn't alone. Which other utility players are seeing this repricing effect?
Any company that's positioned in these high-growth data center corridors is seeing elevated interest. Xcel Energy, for example, covering areas with major data center build-outs, has been a massive outperformer.
What are their projections?
Analysts project their growth to run at 6% to 8%, maybe even greater, through the end of the decade. They currently have 1 gigawatt under construction and a staggering 20 gigawatts in the additional pipeline of projects, all tied to AI demand.
And there are others.
Oh, yeah. We're also seeing heightened activity around Southwest Gas, DTE Energy, and EXC, that's Exelon, as they all get approached for these multi-decade PPAs.
And the economic value, it extends well beyond the utility itself, right? It flows into the infrastructure supply chain that enables this massive power build-out.
That's a critical point for you to understand. If you follow the electron, the opportunity extends several layers deep.
So where do you start?
Start with the companies managing the heat. Vertiv Holdings, they provide thermal management and cooling solutions for these high-density facilities. They even partner directly with NVIDIA. Then the connection layer, Amphenol, specializing in high-speed, high-bandwidth connectivity.
And the data itself still needs to be stored and moved.
Absolutely. The need for storage generated by AI caused companies like Western Digital and Seagate Technology to see stock surges of, 130% to 200% in 2025.
And finally, the connections between the data centers.
Exactly. To move all that data at the required speeds, you need fiber optics. Corning, a key supplier of high-speed fiber cable, is essential infrastructure for this entire system.
So if we summarize the bull case for utilities in this whole power infrastructure play, it seems incredibly durable, almost recession-resistant.
It is. Power is the binding constraint, and the data suggests that won't be resolved for a decade or more. The visibility is unparalleled because these PPAs are typically for 20-plus years.
Driving revenue that's largely impervious to economic cycles.
And supported by the most creditworthy companies on the planet. I mean, if you look at the last decade's semiconductor supercycle, which drove incredible gains, there is a very real possibility that essential AI infrastructure, like utilities and their suppliers, could follow a similar path from 2025 through 2035.
But hang on, let's talk about the bear case. If we're seeing this much capital deployed, isn't there a huge risk that if the general AI bubble deflates, this entire utility and infrastructure thesis just collapses?
It's a valid concern, but it's often miscontextualized. AI is a subset of a much larger foundational digital infrastructure megatrend.
You mean cloud, streaming, e-commerce?
All of it. Data centers were already a massive growth sector before ChatGPT even existed. AI is simply acting as a powerful accelerant to an already existing secular trend.
So even if AI growth slowed from say 50% to 20%, the underlying need for high-density computing continues.
It continues. The train has left the station.
So if the AI bubble isn't the primary risk, what is the critical constraint to monitor that could actually slow this momentum down?
The real risk is the bottleneck shifting. As power solutions get secured through these nuclear contracts and new generation buildouts, the constraint could shift elsewhere, and very quickly.
For instance,
We need to monitor transmission capacity, the physical lines moving the power. We need to monitor water, which is needed in massive quantities for cooling these immense data halls.
and regulatory issues seem like the biggest threat to speed.
Definitely. Land acquisition, permitting, environmental opposition, all of it could stall the necessary build-out of new nuclear SMRs or high-voltage transmission lines. If the speed of bureaucracy fails to match the speed of demand, the bull thesis for these infrastructure stocks weakens significantly. That regulatory delay is the key technical risk we watch for.
Okay, let's shift to the technical view, since the market is already beginning to price this in. What does the chart story for the utility sector tell us about the market's realization of this power constraint?
The technical setup is highly constructive. The inflection point for utility stocks, which had really underperformed the broader market for a decade, started quietly in late 2024.
And if you look at the charts, you can identify some distinct phases.
3 distinct phases, yes. First, we had the accumulation phase, running from roughly October 2024 through February 2025. This was the smart money building long-term positions.
And came the breakout.
The explosive breakout phase, from February through July 2025, that's where the narrative hit the mainstream, volume surged, and prices pushed aggressively higher.
And what about the recent action in the back half of 2025?
That's been the consolidation and retest phase. Utility stocks pulled back roughly 10% from their highs, creating a classic accumulation zone for institutional buyers.
And what's telling about that pullback?
It happened on low volume, which suggests that the selling was mostly just portfolio rebalancing, not, conviction-driven abandonment of the thesis. Technically, we have a very bullish setup, a golden cross.
Explain briefly what a golden cross means for someone who might be more focused on the fundamental thesis.
Sure. A golden cross happens when the short-term moving average, usually the 50-day, crosses above the long-term 200-day moving average. It's a classic signal of a major long-term trend reversal that's been confirmed by price action. In this sector, the price, the 50-day MA, and the 200-day MA are all positioned for a sustained uptrend.
So to wrap this up,
To summarize this unsexy supercycle, power is boring, it's essential, and its demand is inelastic. There is no software patch that eliminates the need for electrons. This creates a multi-decade setup where companies providing the foundational power infrastructure have guaranteed demand growth and pricing power.
the conclusion then is that Wall Street has fundamentally underestimated the earnings revisions and the growth rates for these utility companies. They are now backed by multi-decade, recession-resistant contracts signed with the fastest-growing technology companies on Earth. The money in the AI boom isn't just in the chips.
No, it is disproportionately flowing into the quiet, unglamorous infrastructure that enables them. The real question for you to consider is not which large language model wins, but whether the price of power and the availability of baseload generation will ultimately dictate the pace and the geographic location of global AI expansion over the next decade.
See you all in the next Pro Ticker Deep Dive.